Hello, good morning, good afternoon, everyone, wherever or whenever you're watching this. This is Pinnacle Professional College again, bringing you another edition of our lectures. And today we are going to be talking about financial accounting. For those taking financial accounting, whether you're in school, whether you're studying for your ICA, whether it's your CIMA or ACCA, this class is certainly going to help you so much. So let's go right into it. No time to waste, right? So first off, I wanted you to know that this is our YouTube channel, and I want you to subscribe to our YouTube channel. Please go there and subscribe. Just hit the subscribe button. It's the red button. It's right here. Then you hit the notification bell so that anytime I post a video, you will be the first to get it. Very, very important. So this is how our videos look like. This is how the thumbnails look like. So you definitely enjoy it, whether you're taking audits, strategy, financial management, financial reporting, whatever it is. It's on the YouTube channel. And if you have friends who are taking other papers on other levels, you can certainly share to them. And these are our social media handles. On Facebook, this is how our Facebook page looks like. And this is our Instagram handle. Please go there. You can go follow us. And we post more videos and more tips there for you to succeed in your exam. So today's objectives, we'll be looking at what accounting is. And then we'll be trying to understand the financial statement. Then we'll delve into the capital and revenue, expenditure and income. And then we'll talk about other matters. Any other business that will come our way, we would also tackle that. We'll take a stab at that. Okay. So accounting, what is accounting? When we say accounting, what is accounting? Accounting is simply the process of collecting, recording, and summarizing and communicating financial information. So when we talk about accounting, there are four parts to it. And this is very important. You have the collection part, you have the recording, you have the summarizing and communicating. Please don't forget that. You are doing these four things. You are collecting, you are recording, you are summarizing, and you are communicating financial information. So that's accounting for you. So the acronym I recommend that you use to remember what accounting is, collecting starts with the C. Recording starts with an R. Summarizing starts with an S. And communicating starts with a C. So CRSC. So you can use those letters to remember. Don't forget it. Collection, recording, summarizing, and communicating financial information. So why do we even keep accounts? Accounting keeping is essential to the efficient running of any business. It's essential to the efficient running of a business. It's very, very essential because it helps managers to check the control of resources and keep track of their assets and liabilities. We'll be talking about the meaning of assets and liabilities later in this lecture. Also, keeping accounts will show us our sources of funds and how our funds are used. It will show our sources of funds, where the money is coming from and how it's being spent. So the source and the use of funds. Keeping accounts will show us that. Then you also have the fact that keeping accounts helps managers to know how the business is performing. It's only fair, right? Because once you are keeping accounts, you are able to tell how your business is performing financially. And keeping accounts also helps you to understand the activities and resources of a business. So these are some of the examples why we keep accounts. These are some of the examples why we keep accounts. So let's move on to the next slide. The next slide, we talk about the users of accounting information. Remember, in our definition for accounting, we said accounting is simply, remember CRSC. Accounting is simply what? Collection, recording, summarizing, and communicating. So we are communicating to people who use accounting information. So accounting information is required by a range of users, both within and outside the organization. So let's look at some of the users of accounting information. Let's look at some of them. Number one is managers. Managers are users of accounting information. They use accounting information to make planning decisions, to assess the current and expected future financial situation of the business. So they need accounting information to be able to plan and to be able to make decisions, to be able to assess the current performance of the business, and also make future assessments of the company. Very, very key. They also have shareholders, right? They also have shareholders. And shareholders, this is how they use accounting information. They want to know how well management is performing by looking at the accounts or the accounting information. It tells them how well the management is performing and how much profits they can make. Don't forget that shareholders invest their money into a business. And if you invest into a business, you would want to make profits. And you also have providers of finance to the company, people who lend the company money or company's money. But what do they need accounting information for? They need it to be able to understand the credit worthiness of the company. What do I mean? When you have a provider of finance, right, they give you some amount of money. What they are interested in is whether you be able to meet the interest payments, whether you are credit worthy enough to pay them back their money. So that's the interest when it comes to providers of finance. That's where their interest lies in terms of using the accounting information. They want to know whether this company they are lending money to will be able to pay back. Then you also have employees. With employees, they need to know about the financial situation of the business, to know the financial standing of the company they are in, and how it impacts their career and even their salaries. If a company is not doing well, it certainly impacts employees. So employees will want to understand accounting information in that regard. They also have financial analysts and advisors. They need information for their clients. So, for example, stockbrokers like this, they need information to advise investors. Then you have tax authorities, they want to know about business profits in order to assess the tax payable by the company. They are more interested in how much tax you are going to pay as a business. So they need to understand how much profit are you making so that they can assess the tax payable. You also have trade contacts. Trade contacts are simply suppliers. So suppliers want to know about the company's ability to pay back the goods the company receive on credit. So suppliers and companies would have arrangements where they will give goods to them on credit. These suppliers want to understand, can we, are these people going to pay our money back? Do they have an ability to pay back their debts to us? So suppliers want to know about the company's ability to pay its debts. We are talking about suppliers of goods to the company on credit. These people sell goods to the company on credit, and they would want to know whether the company can pay them back. Then you have governments and their agencies. So these people, government is more interested in the allocation of resources, right? and ensuring that resources are allocated in an appropriate manner. And they also need accounting information as a basis for national statistics. They need accounting information as a basis for national statistics. Governments, again, are more interested in the allocation of resources. That's what they use accounting information for. So those are some uses of accounting information. Now, it's important to understand the difference between financial accounting and management accounting. There's a difference. So the difference between financial accounting and management accounting. So when we talk about financial accounting, what do we mean? What are the differences? So financial accounts detail the performance of an organization over a defined period. But management accounts are basically used to record, plan, and control organizations' activities and help to make decisions. The whole purpose of management accounting is to help decision making. So that's one difference. The financial accounts just tell us about the performance of an organization over a time period or at the end of a period. Management accounts are more of, they help us to, or they help management to make decisions. They help management to make decisions. Then limited liability companies. Another difference is that limited liability companies are mandated by law to prepare financial accounts. But there's no legal requirements when it comes to management accounts. There's no legal requirements. Also, another difference is that the format of published financial accounts is determined by international accounting standards. So one international accounting standard is IAS 1, which is the presentation of financial statements. So there's a standard that governs how you should publish and present your financial statements. But for management account, there's no such thing. The format of management accounts is entirely at management's discretion. Management determines their format. So that's the third difference. The fourth difference is that most financial accounting information is of a monetary nature. It's usually monetary. It's all about money, the numbers. But management accounts incorporate non-monetary measures. So things like impact on employee morale, things that are non-monetary, management accounting will look at it. The fifth difference, which we'll talk about, which is very, very key, is that financial accounting focuses on historic information. Financial accounting focuses on what has happened in the past. So financial accounting looks at, okay, what has happened in the past, and then records it and communicates to users of accounting information. But when we talk about management accounting, management accounts are both a historical and a future planning tool. So management accounting is more futuristic. Financial accounting is more historical. There's a futuristic dimension to management accounting. Please keep this difference in mind. Very, very important. Then one last thing I'll add to you is that financial accounting concentrates on an entire business, the business as a whole, but management accounts can zone in on a specific area of the organization's activities. It can touch on a specific area. Very, very key. Very, very key. Let's talk about the financial statements. Let's look at the statements of financial position and the income statement. So when we talk about the statement of financial position, what exactly do we mean? The statement of financial position is basically a list of the assets owned by the business and all the liabilities owed by the business. So statement of financial position is listing your assets. That's what your assets and liabilities are. It's very simple. Breaking it down to, in simple terms so that you can understand. Then the income statement is basically a record of income generated versus expenditure incurred. So it's your income and your expenditure. Income and your expenditure. That's the fundamental understanding when it comes to the financial statements. When it comes to the financial statements, one of the important principles when it comes to the financial statements is the accrual concept. The accrual concept. So I thought we need to understand this accrual concept even before we jump into anything, right? We need to understand the accrual concept. So the accrual concept means that income and expenses are included in the income statement in the period in which they are earned or incurred. Let me repeat that again. So the accrual concept means that income and expenses are included in the income statement when they are earned or incurred, not received or paid. So what does that mean? So the accrual concept is saying that, income is earned, expenses are incurred. Income is recorded in the income statement when it is earned. So what do we mean by when it is earned? Okay, so let's say you provide a service, a cleaning service to some organization, right? Once you fulfilled your obligation to provide that service, you've earned income, you've earned it. You might not have necessarily received cash for your work, but you've earned it. So the accrual concept is saying that you record income in the income statement when it is earned, and not when you receive cash for it. You might receive cash at a later date, but immediately you perform the service, you earn income, and it qualifies to be recorded in the income statement. Now, the accrual concept is also saying that expenses are also included in the income statement when they are incurred. So let's say again, right? Let's say rent, right? Once you are living in the apartment, maybe your time of rent payment is not due, but once you are living in the apartment, you've incurred the expense. You have an obligation to pay. It's just that you haven't necessarily paid it in cash. So that's the difference between earning/incurred versus received or paid. When we are saying received or paid, we are talking in terms of cash, physical cash. So the accrual concept is different from the cash concept or the cash basis of accounting. So let me explain this again, because I really want you to understand this. So the accrual concept is saying that income and expenses are included in the income statement when they are earned or incurred. So when you earn your income by providing a service, right? The person you are providing a service to might not have paid you. It's possible that it's not time for them paying you cash, but you have earned it. And at the point of earning, it should go into the income statement. Likewise, when you have an expense, right? You are living at a place, and you are living at a place, as so far as you are living at that place, you've incurred the expense, but it hasn't necessarily gotten to the time where you pay for it in cash. So please keep this in mind. The accrual concept is not a cash basis. It looks at things from an earning and incurring point of view. The accrual concept means that income and expenses are included in the income statement when they are earned or incurred. So you do not necessarily have to receive or pay cash for it to qualify to go into the income statement. That's the whole point. The accrual concept is important because it underlies the preparation of the income statement. It underlies the preparation of the income statement. That's why in the income statement, you have items like rent. You might not have paid the rent in cash, but you've incurred the expense, and so it goes into the income statement. You see the logic? You see the logic. So, and in the income statement, you can have revenue, revenue, and in revenue, it's not always cash, right? There are some revenues that you have in terms of, you have the credit side of things, but you've earned it, you've earned it. So that's why it goes into the income statement. Very, very important. Very, very important. So let's look at an example when it comes to the accrual concepts. Ima has a business printing and selling t-shirts. In May 2007, she makes the following purchases and sales. The invoice date of purchases is 7th May 2007. The numbers bought and sold is 20, amount 100, date paid 1st June 2007. Then these are the sales dates. 8/5/2007, the numbers bought 4, amount 40, the date paid 1st June 2007. So the dates go like that. These are all the dates. I'm hovering the mouse there so you can see. These are all the dates and the numbers bought and sold with the amounts. So very, very important. Very, very important. You see, if you realize they are giving us the dates paid here, so it has a meaning. It has a meaning. So they're asking, what is immense profit for me? For the month of May, what will be immense profit? So I just put in the solution here so that it will be quite easy for us. It will be quite easy for us. It will be quite easy for us. So if we are operating on a cash basis, right? If you are operating on a cash basis, then for the month of May, let's go back to the question. For the month of May, if you look in the month of May, right? If you look in the month of May, January, February, March, April, May, you see that in terms of sales, let's go back to the solution. In terms of sales, you see sales is 0. And the reason why it is 0 is that, the invoice date for the sale was what? 8th May 2007. The number bought and sold is, the number sold is 4. The amount is 40. But the date it was paid for was 1st June. So the date it was paid for wasn't in May, but was in June. And so for the month of May specifically, on a cash basis, sales will be 0 because they didn't receive cash in the month of May. They received it in June. In June, yes, the amount will be 40, but in May, the amount will be 0. And it is the same for all the sales transactions because all of them were paid in June and July. All of them were paid in June. Let me mark them so that you can see it clearly. You can see. All of them were paid in June and July. So in May, all of them were sold. The money was made, The money was made in June and July. The sales came in June and July. So in May, the sales number will be 0 on a cash basis. Because we didn't receive cash in May. They told us the date paid. This is the date paid, right? It's right here. So they told us the date paid. It's all, this one is in June, this one is in June, this one is in July. So in May, we have 0. We didn't get cash. So on a cash basis, it's 0. Then now let's move on to purchases. So purchases also was 0. And I'll show you why it was 0. So 0 because again, same principle here. Look at the dates paid, right? Look at the dates paid. It's in June. It's in June. Very, very nice. You know, it's in June. So it means that in May, purchases will be zero. There was no payout. There was no payout. See, the purchase was made on 7th May, but on a cash basis. You are talking about cash basis here. The money was paid in June. Was paid in June. So with respect to May, because we are looking at the profits for May, with respect to May, purchases will be zero because the date it was paid was in June. It's in June. So that's how come you have zero here on a cash basis. On a cash basis. Please keep that in mind. You are looking at the cash basis. Let me underline it so that you can see it. You're looking at the cash basis. So 0, 0, and the profit or loss will be 0. But now let's look at the accrual basis. That would be quite different, right? Let's look at the accrual basis. Let's look at the accrual basis. So for the month of May, right? For the month of May, let's look at the accrual basis. For the month of May, our focus is on month of May. So on the accrual basis, we are looking at recording income and expenses when it is earned or incurred rather than received or paid. On the cash basis, we are looking at receiving and paying. So let's start with first of all, let's start with sales, right? Sales. Let's start with sales. So remember, sales will be recorded when it is what? Earned. When it is earned. I'm taking my time slowly so that you can understand this. When it is earned. So at what point is sales earned in the accrual basis? When it's actually sold. When it is sold, it is earned. When you sell a good or the t-shirts in this case, you know, you've earned sales because the other party has an obligation to pay you, maybe at some time in the future. So this is 8th May, this is 12th May, this is 23rd May, you know. So, and these are the amounts. So your sales will be 40 plus 60 plus 100, which is how much? 200. 200. We are looking at the accrual basis here, 200. 200. So that would be your sales value, right? That would be your sales value. Then now let's move on to purchases. The purchases value will be 100, but I just wanted to show you in the solution. So minus 100 because purchases you are paying out. So minus 100. So, but let's see why it's 100. Let's see why it's 100. So if you go back to the question, you would realize that purchases was made in 7th May for $100, right? So 200 sales, 100 minus 100 purchases will give us 100 profits. You realize that for the accrual basis, we totally ignored the dates paid section because it's not about when you receive or pay cash. It's not about that. So we totally ignore that. You know, it's very, very key. Very, very key. Very, very key. Let me put that in red so that you see that we totally ignore this side when it comes to the accrual basis. When it comes to the cash basis, yes, we use this side. We focus on the dates paid and dates received. Very, very important. Very, very important. So, so that I hope that gives you some understanding when it comes to the accrual basis and all of that. Very, very key. Very, very key. Now, let's use this to create, you know, some simple form of. So we've looked at we've looked at the income statement. This will be the income statement, right? This will be a simple income statement. Let's look at a statement of financial position. It's getting interesting. Let's look at a statement of financial position. You know, let's look at a statement of financial position. So the first asset The statement of financial position, we said it lists what? Assets and liabilities. Assets and liabilities. Assets and liabilities. So let's read a little bit of commentary. It says the accrual basis gives a truer picture than the cash basis. That's very, very true. Emma has no cash to show for her efforts until June, but her customers are legally bound to pay her, and she's legally bound to pay for her purchases. So that's very, very key. That's very, very key. So let's talk about the statement of financial position. Under the asset section, we have receivables. Receivables. So when we say receivables, these are your debtors, people who owe you. Receivables, people you would receive from. Your debtors, people who owe you. People who owe you. That's very, very important to understand. Very, very important to understand. Okay. So who are your receivables here? Right? Who ought to be your receivables here? Your receivables basically would be around your sales. A receivable is created when you sell something. Because somebody will not owe you if you don't sell them anything, you don't give them something. So they will be around your sales. So your receivables will be your 40 plus 60 plus 100 here. And the reason why they owe you in the month of May, again, we are looking at the month of May, they owe you is that they'll pay, for example, this first transaction, 8th May 2007, they are going to pay in June. 12th May 2007, they are also going to pay in June. So in the month of May, they are debtors and they owe you, they are receivables. Very, very important. So in the asset section of the statement of financial position under receivables, you should be able to see let me show you. Okay, you see, you should be able to see 40 plus 60 plus 100, which is 200. Very, very important. Then you also have proprietor's capital or equity. Your equity here would be your profit of 100. So that's what you see here. Your profit of 100. That's what you see here. They also have some payables. So payables are what you owe other people. Receivables are what others owe you. The name, you can use the name to remember. Receivable, something you will receive. Payable, something you pay. So where do we find this payable? Payable relates to purchases. Receivable relates to sales. Purchases. And the way you can remember is that payables, P, purchases, P, so PP, payables relate to purchases, receivables relate to sales. So let's go back to this whole, if you go back to the question under the purchases section, that's where you see the payables. And they are, you see, if you look at it very carefully here, you see that, the payables here will be 100. And the reason it's a payable is because the purchase was made on 7th of May and it's supposed to be paid in June. So in the month of May, right? In the month of May, you have a payable of $100. $100. Very, 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 very interesting. Very, very interesting. So you see, you have assets of 200, proprietor's capital 100, and then payables of 100. Now, if you add a proprietor's capital to the payables, you get 200, right? And so 200 versus 200, it means that your statement of financial position has certainly balanced. So in accounting, your assets is equal, which we'll be talking about later, is equal to your C, which is your capital, plus your L, which is your liabilities. So you see, you have to add the liabilities to the capital, 100, which gives you 200. And then it balances with the assets, which is also 200. So this is a simple picture. I wanted to use this to explain the accrual concept and make it a lot more clearer to you. So I'm hoping that you understood that very, very clearly. So what is capital? When we say capital, what is capital? Capital is simply a special form of liability. It's a special form of liability which represents the amount owed by the business to its proprietors. So when we say capital, in simple terms, when we say someone has capital, it's the money they put into the business. The money they put into the business. In law, the business is seen as a separate entity. It's seen as a separate entity. And so if you are putting money into the business, like you are giving money to another person, so the business owes you. The business owes you because you are putting money into the business. So that's why it's a special form of liability that represents the amount owed by the business to its proprietors or to its owners. To its owners. Very, very important. Very, very important. Very, very important. So that's something you would want to keep at the back of your mind. What capital is. That's something you would want to keep at the back of your mind. Then let's talk about assets and liabilities for a little bit. Let's talk about assets and liabilities. We have profit-making enterprises. We have non-profit-making enterprises. So what are profit-making enterprises? These are enterprises that exist and their objective is to make a profit. Profit is simply income over expenditure, like we've always seen. Then there are also organizations who are non-profits. It means that their main objective is not to make profit. Their main objective is to render a service. It's just like a government agency. The typical example is a charity. A charity is basically focused on providing a service. Their main objective is not to make profit. You have clubs and associations as well. Very, very important. Very, very important. Very, very important. All enterprises, profit-making or not, will produce financial statements to provide information to interested parties. For a business, the most important statements are the statements of financial position and the income statements. So I just wanted to touch on this a little bit, and then you kind of understand where I'm coming from. You kind of understand where I'm coming from. When we are explaining capital, we said that capital is a special form of liability because it represents monies owed by the business to the owners. Because I explain capital as money you put into a business. But the reason why that explanation is given is that the business is seen as a separate entity. So there's a concept called the entity concept. And the entity concept treats the business and its owners as separate entities. So the business is seen as a distinct legal personality, which can sue and be sued. So a business can sue someone, and also the business can also be sued. So the business is separate from its owners. Always see it that way. So if the business is separate from its owners, then when the owners are investing capital, it's like, the business is borrowing from the owner and needs to pay the owner back. Do you see? Because they are distinct personalities, because this concept is crucial to understand the preparation of accounts. And this applies whether or not the business is recognized in law as a separate entity. So it is very, very crucial, very, very crucial that you understand that the business and the owner, these are separate entities. They are not the same, please. They are not the same. They are not the same. They are separate entities. And the business on its own is a distinct legal personality that can sue and be sued. Very, very important. Very, very key. So there's an example here. Suppose that Patricia sets up a business as a hairdresser. The law sees no distinction between Patricia, the individual, and the business known as Patricia's Saloon. Any debts of the business which cannot be met from business assets must be met from Patricia's private resources. However, the law recognizes a company as a legal entity quite separate from its owners. So when we are talking about a legal entity, a company, a limited liability company, it's separate from its owners. Always keep that at the back of your mind. Companies are separate from their owners. A company has the right to acquire assets, incur debts, enter into contracts, etc. A company can become bankrupt, but the owners themselves might not be bankrupt. And in a limited liability company, the owners are not necessarily required to are not necessarily required to pay, use their own money to pay for certain things in the company. They are not necessarily required because the company itself is a distinct legal personality that can do things on its own. It can acquire assets, it can pay for its expenses, it can incur debts, etc. And that's why there's the concept of limited liability. Limited liability. And when we say limited liability, it means that in the event of bankruptcy or dire financial situations, the liability of the company is limited to the company itself. The liability in such a case is limited to the company. It does not extend to the owners. So that's why we call it a limited liability. Always keep this in mind. Please, always keep this in mind. The entity concept undergirds the preparation of accounts. The business is seen as different from the owners. That's what you need to keep in mind. The business is seen as different from the owner. So this is where I'll bring it to an end today. Thank you for watching. Thank you for listening. And certainly, if you have any questions, you can drop it in the comments. We'll respond to it. And, if you haven't subscribed to this channel, please do so. We always post videos here, multiple times in a week. And so it will help your journey in taking your ICA, ACCA, or CIMA exam. And thank you so much for watching. Stay blessed.